Alright guys, this is Nick again. Thanks for joining. I wanted to spend our last shoot on the topic of compliance with Sarbanes-Oxley, and specifically on the theme as to what practical steps need to be taken in order to comply with 404 requirements. And on this topic, I wanted to first briefly talk about two main sources of information that you guys will need to consider as part of the implementation effort. Number one is Audit Standard number 5, an audit of internal controls over financial reporting integrated with a financial statement audit. Number two, COSO framework, originally issued in 1992. Now, AS5, published by PCAOB, is strictly speaking an audit standard, right? And not that much relevant to management per se, implementing Sarbanes-Oxley, but provides a pretty solid understanding as to what healthy internal control framework is, right? So if your company will need to be audited, obviously you may want to be aware as to what audit procedures will be. A. B, oftentimes as part of the implementation and ongoing compliance effort, management will have to perform its own testing of internal controls, and that's where the guidance, strictly speaking, relevant to external audits may come in handy. So that's AS5. COSO framework really provides a solid, very popular, very widely adopted approach as to what appropriate internal control framework and system of internal controls is. You guys, I'm sure, remember that cube, COSO cube, that has 5 COSO internal control components on the front end, the breakdown of those between entity level, divisional level, all the way down to the functional level on the right hand side, and on the top end there is the breakdown between reporting, compliance, and operations, right? So I don't want to spend too much time talking about COSO framework, but I just wanted to briefly mention 5 individual components that enter into that definition. Number 1, corporate environment. Number 2, risk assessment. Then control activities, information and communication, and last but not least, monitoring activities, right? Those 5, and that kind of gives you a high level understanding as to what the COSO framework is. FINECO really developed a very simple 4-step approach to implementing of the system of internal controls, and I wanted to take you guys first quickly and then a little bit more details through each of those 4 steps. Step number one, identify key financial reporting cycles. I'm sure you guys are familiar with examples: revenue and AR, accounts payable and AP, income taxes, financial close, treasury, stuff like that. For each of those 4 steps, I forgot to mention this in the beginning, there is a kind of doing component and there is a documentation component. And the first step is not an exception. We first need to sit down and think through what our financial reporting cycles are, and then we also need to document them. What makes sense along with as part of the documentation effort is to document not just cycles one by one, it's not just the list, but document key flow of information and activities that are taking place within each individual cycles, right? So in other words, what's happening within each. So that's step number 1. Step number 2, within each financial reporting cycle, identify as part of step 1, let's identify key controls. There is not that much of a formal definition as to what key controls are, but some guidance around it, provided in COSO framework as well as in the AS5, says that key controls are those controls that management believe are important to reduce the risk of material misstatement in their financial statements to an appropriately low level, right? So in other words, in each financial reporting cycles, we want to identify those key checks, controls that make sure that financial information is free of misstatements or free of material misstatements, and we want to make sure we document those controls. Step number 3, perform and document walkthrough of internal controls to ensure that their design is appropriate. Step number 4, test and document the results of testing performed around operating effectiveness of internal controls and evaluate exceptions, if any. Generally, there are some exceptions. So this is high-level overview of step 1 through 4. Let me spend a little bit of time to talk about each step individually. Step number 1, key financial reporting cycles. They're really driven by the specifics of the business model. As you guys can probably imagine, financial reporting cycles for a manufacturing concern will probably different from healthcare organization, a bank, or an insurance company. Financial reporting cycles can be defined with a different level of detail. They can be as aggregate as, let's say, revenue, AR, and collection, or we can define them a little bit more at a little bit lower level, such as revenue will be one cycle, accounts receivable will be another cycle, and collection will be third cycle. Depending on the size of the business, depending on what the business actually does, how much is actually happening within each of those three or within this one aggregate cycle, it makes sense to either take a look at them in aggregate as one cycle or three cycles individually. Even when we define, regardless of how we define financial reporting cycles, it makes sense to document and understand not just what key financial reporting cycles are, but also figure out what our sub-processes or sub-activities within each cycles represent. I'll give you an example for revenue. What is happening, the specific activities happening within revenue cycles generally include contract signing, PO processing, shipping process, revenue recognition, right? So, and that would be for revenue alone, right? So we need to figure out what those sub-processes are, or sometimes people call them sub-cycles, and document them clearly in the same fashion as we documented our reporting cycle. So let's talk briefly about documentation though. We need to clearly document process and document flow for each reporting cycle. We need to clearly identify folks, accountants involved with specific activities and specific bits and pieces of the information flow. We need to clearly identify the activities performed as well as roles of people doing individual specific tasks. Last but not least, on step 1, I think it's more important than at this level to get the step right. And the reason I say this is because everything else that will be happening later in the implementation process, such as figuring out what key controls are, testing them, really depends on how solid the underlying foundation is. In other words, if we didn't identify our financial reporting cycles accurately, if the foundation is a little bit shaky, whatever else we're going to build on this foundation may well be shaky as well. So let's make sure we invest substantial enough time and effort to make sure that financial reporting cycles are identified appropriately along with the sub-processes as well as documented well as well. But enough clarity, enough level of detail provided as part of our documentation level. Step number 2, identify key controls. Controls as such are not really defined in either audit or even legislation. Some of the controls may have direct relevance to financial information, such as contracts performed to make sure that, I don't know, balance sheet agrees with the subledger or subledger with the ledger, or ledger agrees with subledger or subledger agrees with a detailed listing and things like this. Some controls may not be as directly relevant to financial information, accuracy of financial information, but do have indirect relevance, such as making sure that SAP or other financial reporting or access to other financial reporting system is restricted, and password, and those passwords are regularly reviewed and updated when necessary. There are multiple categorizations of controls. Controls can be divided into entity level, divisional, transactional controls, depending on the level at which they operate in the context of the whole company. And that kind of takes us back to the right-hand side of the COSO cube that we talked earlier in our presentation. Controls can be divided between detective and preventive. Detective controls make sure that they identify the misstatement before it takes place. Preventive controls make sure that when the exception takes place, its financial impact on the financial information is mitigated. Controls can be divided between manual and automated, and that means what the name suggests, whether they're performed manually with someone's hands or as part of the system's functionality. There is a separate group of controls referred to as ITGC, Information Technology General Computer Controls. It's kind of crazy, I still remember this. The ITGC group also has, I believe, 4 different components, such as password policy, system development and changes, and system operation, right? So there are those other subcategories within ITGC that each of which provides its own separate set or subgroup of controls. We already talked about key controls. Those are just really more important controls that management believe are consequential or bear greater relevance when it comes to ensuring that companies' financial information is accurate. Like I already said earlier, it's important to not just identify those key controls, but also properly document them. It also makes sense not just to document them in some sort of listing of all the controls, but tie this documentation to our documentation of key financial reporting cycles and sub-processes that was performed as part of step 1. In other words, in an ideal world, the way this documentation looks like is that we first document key financial reporting cycles and what's happening within each, key activities, flow of information, and then as part of this documentation we identify key controls and document them as such in the same document, which puts documentation of key controls in the proper context. Alright, so this is step 2. Step 3, walkthroughs. There are really 2 main parameters that are assessment parameters that are relevant to testing of controls. First is, assessment of the design, and second is assessment of operating effectiveness. Name mean here what they suggest, right? Effectiveness of the design pretty much means that the control was developed and set up as intended to appropriately reduce the risk of material misstatement. Operating effectiveness means that the control operates actually in practice effectively, right, to prevent the material error taking place. There are actually 2 functions in the design, in testing of controls design. Number 1, we want to make sure that design is working fine and the controls were developed as intended. And number 2, we want to make sure we have a solid enough understanding of those controls, right? So before we kind of jump into testing of operating effectiveness, before we formulate our conclusions, of course, we want to make sure we clearly understand what is that we're dealing with. Operating effectiveness, just like I already said, really deals with the fact that controls actually operate as intended. So the reason we're talking about walkthrough in this specific case is the fact that this is considered to be the most appropriate tool to make sure that the design of the control is adequate. We perform the walkthrough one more time to make sure that the controls are designed as intended. The way walkthroughs are performed is by means of tracing one transaction from the beginning to the very end and checking how individual controls operated along the way. This is the walkthrough. There are pretty much 4 main testing strategies or testing methods for each individual control. And by testing, I don't mean testing of operating effectiveness, but also checking the effectiveness of the design. Those 4 are inquiry, observation, inspection, and reperformance. Right, one more time. Inquiry, inspection, observation, and reperformance. Inquiry is just asking appropriate questions of management. Observation is actually observing how control operates. Inspection means reviewing certain supporting documents relevant to operation of the control. And reperformance is actually reperforming the whole control to make sure that it is designed as intended. These are the same 4 methods that are used for control testing. The audit standard is very clear in saying that inquiries alone is not sufficient in testing of controls, in testing of operating effectiveness of the controls. The standard is also saying that risk associated with the performance of the control is there. It doesn't say it like that, but it really implies that risk is the single most important factor that drives control testing strategy or testing of operating effectiveness of the control. However, the way most accounting firms set up their testing templates or their kind of tables that show how many controls will have to be testing depending on individual factors illustrate that the single, oftentimes most important factor that drives the amount of the sample size, in other words, how many controls, how many instances of the controls will have to be tested, is really the amount of occurrences. The higher the occurrence of the control is, the higher the frequency associated with each control is, the more amount of items will have to be tested. Annual control obviously cannot be tested more than once. Quarterly, monthly, weekly, transactional controls, right? Transactional controls will obviously have to be tested to a greater extent more often than annual controls. For transactional controls, obviously it will be hard to establish what the individual amount of occurrences is, right? So, but auditors and oftentimes management go through a process of some sort to ensure that they can come up with a good enough estimate as to what the total amount of the occurrences for the transactional controls is. Similarly, many accounting firms set up their own testing templates that are intended to document the result of control testing, right? The testing templates that I mentioned earlier a couple minutes ago were really not testing templates. Those were like tables that show how many controls will have to be tested depending on certain parameters, such as the occurrence of the control or whether it's control manual or automated, right? The testing templates that I'm talking about now are really just the templates that are used to document the result of the control testing. Those testing templates can be big, contain all sorts of information, such as the name of the tester, what testing procedures were specifically performed, description of the control, testing attributes, name of the tester, date of the control testing, whether it is an interim testing of the control or roll forward testing intended to bring the results of the preliminary control testing or the non-year-end control testing all the way to year-end, right? Those templates are generally pretty big in size and require a lot of input information in them. One of the key topics relevant to control testing is the accuracy of underlying information. The idea here is that whatever underlying reports or some other information used in the control while controls are executed, and specifically information and reports that the control itself relies on, will drive the effectiveness of the control itself, and this information, those reports, will have to be looked at as part of the control testing strategy. This sounds a little bit abstract, so let me give you an example. The control is that the CFO reviews financial information on a quarterly basis, balance sheet and income statement, identifies significant variances, let's say in the balance sheet or income statement quarter over quarter, and provides appropriate explanations with regards to each variance. Understandably, how meaningful those explanations are and how meaningful the whole control is depends on how accurate or most up-to-date the underlying financial information is. If the CFO performed his variance analysis using outdated or preliminary financial statements without further audit adjustments or even management adjustments, the operating effectiveness of the whole control is questionable. And that's where the idea of the accuracy of underlying information comes into play. In other words, we want to make sure, or the person who is responsible for operation of this control wants to make sure, in this specific example, that the financial information, balance sheet and income statement, that are used to perform the variance analysis are most up to date, period. So these are 4 steps, right? We went through them quickly. We took a little bit more detailed look at each. What I wanted to do now as part of the wrap-up is to kind of bring to your guys' attention a couple of other concepts relevant to the system of internal controls. Number 1 is what the audit standard refers to as a top-down approach. The audit standard is very clear, AS5 audit standard, that we first obtain understanding of the internal controls, and only after that we go on to test the design as well as operating effectiveness of those controls. The audit standard is also very clear that we first test entity level controls, then divisional level controls, and all the way down to transactional level controls. So I personally think that this kind of basic notion as to what comes first, what comes next, provides auditors and management with very effective and important management tool that can be described in just one sentence. We think first and then we act next. We understand first and we execute next, not vice versa. So I think this is a very helpful idea. Second and last concept that I wanted to bring to your guys' attention has to do with the difference between 404A and 404B approaches. 404 is really just a reference to a paragraph in Sarbanes-Oxley Act that introduces the requirement with regards to management or auditor's responsibility to assess the effectiveness of internal controls. And specifically, 404A requires management to report, to assess and report on the effectiveness of internal controls. And 404B introduces the responsibility of an independent audit firm to provide certain procedures and report its opinion on the effectiveness of internal controls, right? So A, management, B, auditors. There are a number of companies that would be exempt from 404B and will be subject to 404A only. All non-accelerated filers, including small reporting entities, defined as entities with a public float being 75 or below $1 million as of the end of the most recent second fiscal quarter, and debt filers will not be subject to 404B, but will be subject to 404A only. So management will have to report, will have to assess and provide certain level of assurance to investors, to readers of their 10K filings, but auditors will not have to be involved. Emerging growth companies, companies with a revenue of $1 billion or less, will be exempt from 404B requirements for 5 years. There are a number of group of companies, public companies in the United States, that will be exempt from 404A and 404B. For example, first-time filers will be exempt, will only report compliance with 404A and 404B in their second 10K. So in principle, they can enjoy the exemption for as long as 2 years. Now, newly acquired companies can also be exempt from 404A and 404B compliance for up to a year subsequent to the acquisition, provided all the appropriate disclosures are met. Alright guys, that's all I've got to say about Sarbanes-Oxley. We briefly covered the internal control requirements. We briefly covered the implementation effort. Please stay tuned, and thank you so much for your attention.